Hello and welcome to Macro Pulse. In today's episode, we're going to look at the outlook for the rest of 2025. We will look at the current policy environment and the implication for assets. And we will finish by looking at the most recent developments in the local economy. From a policy perspective, we started this year saying that this will be a very disruptive and erratic policy environment. And we've seen how policy uncertainty has become elevated. It remains quite high, although it has come down slightly, and we believe that it will remain volatile during the next few months and only start to improve by potentially 2026. But let's look at the different policy dimensions that has driven this uncertainty. We start off with monetary policy. On the monetary policy side, the Fed has been on hold. Growth has slowed, but not enough to convince the Fed to cut rates. And on the inflation side, inflation has remained sticky around 3% and now risk rising above 3% as a result of the increase in tariffs. The recent CPI report from the US shows that some of the import components are starting to rise in price. Apparel, household appliances, and recreational goods are all rising on a month-to-month basis during the most recent report. And we believe that the tariffs and the impact of the tariffs will, over the next few months, start to play out and drive inflation above 3%. This makes it very difficult for the Fed to cut rates. The Trump administration has become very critical of Fed Chair Powell for not cutting interest rates, to the extent that they've even threatened to fire him. The Fed Chair is typically being appointed by the president, and Powell was appointed by Trump during his first term in 2018 and cannot be removed unless it's for reasons of course, meaning malfeasance or fraud. Now, the Trump administration at the moment is actively looking and investigating ways in which they can still potentially replace Powell. Although it's a low probability scenario, it's not zero. But even if Powell gets replaced by a new Fed chair, it's unlikely that it will impact monetary policy significantly. Policy rates are set by the 12 voting members of the FOMC, and it's unlikely that the chair will influence those other votes. However, the big risk here is that the reputational damage to Fed independence could weigh on US dollar assets. Then if we look at the fiscal policy, the One Big Beautiful Bill Act was signed by Trump and passed by Congress in the early part of July. This bill essentially shows that there will be increased spending and tax cuts that will hit the economy in the early part of this bill, with spending cuts only coming in from about 2029. So over the next few years, we will potentially see fiscal expansion starting from 2026. And this will again work against the Fed's aim to reduce inflation. We've also seen that this fiscal package has driven some concerns in the bond market, and bondholders have become concerned about fiscal dominance. The yield curve has started to rise. We see now that 30-year treasury yields in the US is close to 5%. But it's not only a US phenomenon. We also see other developed markets around the world, including the UK and Japan, whose bond markets and yield curves are steepening as a result of concerns about bond investors. So suddenly, the fiscal landscape for emerging markets has become more attractive relative to many developed markets. On the trade policy front, which has been the most disruptive policy dimension, we've seen a peak in policy uncertainty in the early part of April. And since then, and likely due to a lot of pushback from the market, other business leaders, and also voters, Trump has reversed and backpedaled on some of his policy intentions. We saw that the reciprocal tariff has now been delayed up until the 1st of August, and we saw that a trade truce has been signed between the US and China, so scrapping all the retaliatory tariffs. We've seen that a trade deal has been signed between the US and the UK, Indonesia, Philippines, and Japan more recently, and there's a likelihood that a similar deal would be signed with the EU. So what can we learn from these trade deals? The ultimate tariff rate has come in lower than the headline reciprocal tariff rate that was announced on the 2nd of April. So a better tariff rate, but still very high, especially considering that many of these countries are strategical partners to the US. Now, this doesn't bode well for South Africa, who is facing a 30% tariff rate on the 1st of August. We will have to see, because Trump has also said that he is still open to negotiations. On the best, South Africa may face a marginally lower tariff rate than the 30%. Tariffs are growth negative and inflationary, and we will expect to see the impact of these tariffs still to flow through the global economy over coming months. Then, if we look at the foreign policy side, Trump in his second term, one of his first ambitions was to create a ceasefire between Ukraine and Russia. Thus far, we haven't seen any progress on that front. The Trump administration is now threatening Russia with more sanctions, increased defense spending and defense support to Ukraine, as well as potentially secondary tariffs on oil exports. The Middle East tension did reach a peak around about the mid part of this year, with the US attacking and damaging a lot of the Iran nuclear facilities. That tension has now faded as Iran decided not to retaliate in a very forceful manner, and that risk has now, although it's still a long-term risk, has now faded in the short term. The tension between the US and China from a trade perspective, but also from a geopolitical perspective, remains a longer-term risk. So as we can see, the US has been a key source to this policy uncertainty. And we can see that also in asset prices. The US dollar has weakened this year. US equities has underperformed many other equity markets around the world, including emerging markets and South Africa. Developed market bonds and long bond yields have risen, and emerging market local debt assets has outperformed developed market bonds. The gold price has continued to do well. As an anti-fragile asset, it's done well. And PGMs, including platinum, is now catching up. The oil price, however, remains low due to global demand issues and also increase in supply. But all of this actually bodes well for emerging markets. Weaker dollar, lower oil price, and relative attractive valuations in emerging markets bodes well for even South Africa. On the South African front, the All Share Index reached a 100,000 index level earlier this week, reminding investors that the economy is not the same as the market. Year to date, the equity market is up 20%, even though our growth for the first half of this year is barely positive. Even bond investors and foreign bond investors are returning to the market and finding our market attractive. Our real rates remain very high. Inflation is coming down, still remains low at about 3%. The fuel prices are low and likely to fall further again. And the SARB is talking about potentially lowering the inflation target, now waiting for the finance minister to agree on this reduction in inflation target. All of this bodes well for bond investors. The low oil price and lower inflation also bodes well for disposable income, and with wages rising above inflation, the real wage is also continued to grow in positive territory, which from a consumption perspective remains supportive. Then if we add on top of that commodity prices are rising again, this could be good for mining revenues, and ultimately that may play out in improvement in government revenues, but also higher income and jobs in the mining sector. We believe that overall there is enough support to support the local consumption. Local consumption or households did take some hit from deterioration in sentiment in the first half of this year, mainly due to volatility and instability around the GNU, foreign policy concerns, and other policy uncertainty. But we believe that as the GNU continues to hold, that growth expectations for this year, which has now been trimmed to below 1%, could actually surprise on the upside. Therefore, we remain constructive on South African or local equities. We believe there's scope for bond yields to fall further and for the rand to appreciate from current levels. Thank you for watching.